A criminogenic environment is a steal from pathology. A pathogenic environment, an environment that spreads disease. In this case, it's an environment that spreads fraud. And there are two key elements. One, we talked about. If you don't regulate, you create a criminogenic environment because you can get away with the frauds. The second is compensation, and that has two elements. One is the executive compensation that people have talked about that creates the perverse incentives. But the second is for these professionals and for the lower level employees to give the bonuses. And it creates what we call a Gresham's dynamic. And that just means cheaters prosper. And when cheaters prosper, markets become perverse and they drive honesty out of the market.
You also wrote that the New York Federal Reserve knew about this so-called three-card Monte routine, but that the man who led it at the time, Timothy Geithner, now the Treasury Secretary, testified that there was nothing he could do.
In our system, the Federal Reserve was a fire station with important, if limited, tools to put foam on the runway to provide liquidity to markets in extremis. However, the Federal Reserve, under the laws of this land, was not given any legal authority to set or enforce limits on risk-taking by large financial institutions like the independent investment banks, insurance companies like AIG, Fannie and Freddie, or the hundreds of non-bank financial firms that operated outside the constraints of the banking system.
Now, what I hear is the gentleman who was then chairman of the New York Fed saying, we had this job to do, but we didn't have the authority to do it.
Yeah.
We were the fire truck, but we didn't have any water in our hose.
Yeah, this was pretty disingenuous, because other portions of his testimony, he explained why there was this gap. And he said it was because we repealed Glass-Steagall. Well, the Fed pushed for the repeal of Glass-Steagall.
Glass-Steagall was the act that was repealed in the late 90s that separated regular banks from investment banks, right?
Correct. So this is a deliberately created regulatory black hole created by the Fed, and then the Fed comes into the hearing 8 years later and said, we were helpless to do anything because of a black hole we designed.
Well, it doesn't stop there, because as I listened the other day, I heard that the Securities and Exchange Commission knew that Lehman was repeatedly ignoring its own risks, but it did nothing. Here's what the new chairman of the SEC, Mary Shapiro, had to say the other day about why the commission fell down on the job. Take a look.
The SEC didn't have the staff, the resources, or quite honestly, in some ways, the mindset to be a prudential regulator of the largest financial institutions in the world. It was such a deviation from our historic disclosure-based and rules-based approach to regulation to come in and be a prudential supervisor. The staff was never given the resources. This program peaked at 24 people for the entire universe of the 5 largest investment banking firms in the world.
Well, this is another example of a self-fulfilling failure. This wasn't done under Mary Shapiro's watch. This was Chris Cox, who was Bush's appointment, and he's the one who decided we're only going to send 24 people to deal with all of the largest investment banks in the world. Now, that's a farce, and everybody knows it's a farce. He didn't want effective regulation. We've both spent considerable time in Texas. And you know the joke, one riot, one ranger, right?
Texas Ranger, right.
Treasury Secretary Geithner testified that in the circumstances they were dealing with at Lehman, we were on the brink of the destruction of the entire global financial system. And then Chairman Bernanke testified how many people the Fed sent to Lehman to prevent us on the brink of global collapse.
And how many?
2. They have a staff of thousands. This is criminal negligence, except because he's a federal employee, we can't charge him with a crime.
Let's talk a moment about the government's allegations against Goldman Sachs. I mean, I get dizzy just reading about it, but the Wall Street Journal reporters did a terrific job this week of trying to sort it out. And they say it centers on a deal Goldman Sachs crafted so that the hedge fund king, John Paulson, could bet on a collapse in housing prices. Is that your reading of it?
Yes, I mean, the complaint actually focuses on lying to investors. So it's a very traditional securities fraud complaint.
Not about Paulson, by the way. He's not mentioned in the complaint.
No, but that's really interesting. And as to whether he will be charged eventually in this complaint, because Paulson has lots of potential liability on this one. John Paulson was allowed by Goldman, indeed encouraged by Goldman, to create a most likely to fail list. So he took, within a particular category, the absolute worst stuff, because he wanted to bet that the stuff would fall in value. And they were certain to fall in value in terms of the economics.
Wasn't he betting that people wouldn't be able to pay their mortgages?
Not even necessarily that, because most of these are liar's loans, again, and they will not pay, right? It's not an issue with liar's loans, will it work or will it not work? It's only when will it blow up. A liar's loan will blow up. If housing prices keep going up for 3 years, usually, then they will blow up in the 4th year. But they will blow up. So he was betting against something that he knew was going to blow up. He didn't necessarily know the timing, but he proved to be right about the timing, because we know from the SEC complaint that he was in a rush to get this. He knew that the housing collapse was imminent, and he had to get this deal done right away. And Goldman Sachs felt the same thing. So they went and they got themselves a dupe, ACA. And they told ACA is a group that puts together and supposedly checks the quality of mortgages. Not very well, as it turned out, of course. An investor would obviously want to know that this portfolio was picked to fail. Instead, they were told, according to the SEC complaint, no. There's no John Paulson out there. There's only ACA, and it's in your corner. And it's picking a portfolio most likely to succeed. Now, if John Paulson knew that Goldman was making those representations, then John Paulson knew those representations were false, and that could make him an aider and abettor.
So tell me where the fraud might be in there if the government proves its case.
Well, the fraud is, I'm representing to you, the potential investor, that a competent professional, independent firm, ACA, looking after your interests, has picked this portfolio because they believe it's most likely to succeed. When in fact, the portfolio was selected overwhelmingly by Paulson and was selected because it was deliberately chosen to fail.
The complaint names only one person, Fabrice Touré, if I get the name correctly.
That is correct.
Who was 27 at the time. Would he have been acting without supervision on a deal of that enormity?